Today's video will do a couple things. First of all, it will serve as a good review for you for three topics, going back to the first semester, topic 6, and then topic 7 that we concluded recently, and then the current topic 8. It will also take us to the next step in our accounting cycle. If you remember way back at the beginning of the course, in the first semester, we talked about the accounting cycle. And it consists of, first of all, business transactions. Something happens with the business financially. That information is put into the two books of the business. First of all, the general journal, and then the ledger of those are the two books we've been using. And from there, it goes to the financial statements. And that's the step we're going to take with this video. So let's take a look at the screen. This is the ABC company. And there are a number of transactions already journalized and posted. And we'll walk through these fairly quickly here. And we want to be able to get to the new stuff, but I want to review just a bit here so we're on the same page. First of all, on the month of February, we're looking at the month of February of 2020 for the ABC company, and it's important to understand that this company has an accounting period of 1 month. So that will be important. And let's take a look at some of the transactions. We, first of all, on the first day of the month, bought office equipment for cash, $7,500, and that is journalized and posted. Both assets, office equipment goes up, cash goes down. Also, it's important to note over here on the right that this office equipment will have a useful life of 10 years. And we expect it to have no salvage value, so it would increase in value. It would depreciate by $750 a year. You take the $7,500 divided by 10, an annual depreciation rate of $750. But the company has a monthly accounting period, so we need to take the $750 divided by 12, and that gives us a depreciation rate of $62.50 per month, and that will be important later on. Then we have three instances where the company bought inventory. On the 3rd of February, we bought inventory for cash. On the 12th, again, more inventory for cash. And on the 18th, more inventory. This time we charged it, so we credit accounts payable. And if you look on the right, each time we did this, the inventory went up a little bit in cost to us. So it costs us a little bit more each time. And that will come into play in a minute. And that's what we talked about in topic 7, if you remember. Then we had one sale. We'll make it very simple here. Just one sale this month. On the 23rd, we have sales totaling $30,000, and customers charged it, and we debit accounts receivable. So on the 23rd, we made sales on account 200 units at $150 each, totaling the $30,000. So that will be important, as we will see at the end of the accounting period. There are 3 entries now that we need to record at the end of each accounting period, and that takes us back to topic 6, and then topic 7, and then topic 8. At the end of the month, we are in February, and we happen to be in a leap year now, so on the 29th of February, we have to record the monthly payroll. We pay our employees once a month in this company, and they earn a total of $15,000, and the company withheld some taxes. Remember how we used to do that back in the first semester? Way down here, we see the entry. Salary expense debited by the total amount that they earned. They earned $15,000, but they didn't get that much in take-home pay. We had to deduct federal income tax. We had to deduct state income tax and FICA tax. Remember, which is Social Security and Medicare. So those are the amounts out of this payroll, this monthly payroll that we deducted out of the paychecks for the employees. We'll pay it later. And that leaves then, if we do the math correctly, we actually paid them an amount of $13,200, and that's credited to cash. So that's the first entry at the end of the accounting period. The second one is also on the 29th, the last day. We have to record the cost of goods sold entry. And this company, if we look over here on the right, uses LIFO, last in, first out method of evaluating inventory. So based on the fact that we sold 200 units and we purchased these at different times and at different amounts, the cost of goods sold is calculated by using the math down below. And if you need to stop and review this again, that would be helpful. But this shows you the math involved in figuring the cost of these 200 items. They cost us $13,360. We sold them, those 200 items, for $30,000, but they cost us $13,360, and that's the entry. We see a debit to cost of goods sold expense, a credit to inventory. And the last one gets into the topic 8 information, and this is the depreciation. So at the end of the month, we need a monthly depreciation entry based on those computers, that office equipment that we purchased way back on February the 1st. And we figured up above that this amount per month, as we said, was $62.50, and then that's the entry we have to put in. We debit depreciation expense for computers, in this case our office equipment, and we credit accumulated depreciation by the $62.50. So those are the journal entries. If we look at our ledger, we can see that we have everything posted here for us. In cash, we have a balance at the end after doing all of these journal transactions. A debit balance of $50,030, accounts receivable. People owed us money beginning at the end of January. They owed us some money, and then we have more accounts receivable during February, and then you see the balance. Inventory, we bought inventory 3 different times, and then at the end of the month we had the entry that credited inventory, the cost of goods sold entry, which leaves us with a balance in inventory of $17,700. Supplies, we had supplies left over from last month. We made some purchases, apparently. We didn't do anything else with supplies. That balance remains. And office equipment, our computers, $7,500 purchased at the beginning of February. And then the accumulated monthly depreciation in our contra account is a credit of $62.50. Liabilities, we have accounts payable, a credit, we owe money. We apparently have a loan that we haven't paid on yet. We owe money for a loan. And then we have the payroll entries that we have 2 in each one, 2 entries. Back in January, we had the payroll entry, the same as we have in February. So federal income tax payable is credited by $900 in January, also in February. That has a balance of $1,800. Now we don't pay that. We haven't paid that tax yet. We only pay these taxes quarterly, so every 3 months. So in March, we will have another entry. At the end of March, we will have a journal entry, and then we will credit federal income tax payable for $900 again, which will give us down here a balance of $2,700. And at the end of March, that's when we pay the federal income tax payable. Same way with the state. We don't pay that now. We recorded it in January. We recorded it now at the end of February. I have the wrong date there. That should be February 29th. $300 for each month. We will do it again in March. Same way with FICA. There was a bit of a glitch with FICA, if you remember, because we have to figure our share of that FICA tax payable as well. We're not going to do that in this problem, however. Owner's equity, we have an amount of money in there as of the end of January. of $62,125. And we have a new account down here, something called income summary. We're not going to deal with that today, but I just want to show it to you because that will be part of what we do in topic number 9. So that's something to look forward to. Income summary, we'll explain that later on. Then revenue. We have sales revenue. Remember, we made one sale this month, $30,000. And then we have this other account, the other revenue account. That came into play yesterday in the problem you had. So that's a new account. We're not using that in this particular demonstration, however. We have expenses, depreciation expense that we journalized and then posted for the office equipment, the computers, salary expense that we had, and then the cost of goods sold expense. So we're ready now for the next step, and that is to take all of this information and put it into these financial statements. There are 2 of them. If you remember way back from the first semester, income statement and a balance sheet. So this is completed for you, but just to remind you how we do this, in the income statement there are 2 parts, the revenue part and the expense part. And we will show, first of all, the gross profit in the revenue. We go to sales and we find in the sales revenue account the credit of $30,000. That's what's put in to the income statement. Then we have to use the cost of goods sold expense, and on the income statement we label it this way, and we put it in here and then show gross profit. So typically, even though this is an expense, it's shown up here as a deduction from sales to indicate the gross profit. Then if we go to these 3 expense accounts, we will debit each one of these, actually 2 expense accounts. From the ledger, we have the $62.50 for depreciation and the $15,000 for salaries, giving us a total of the other expenses of $15,062.50. Subtracting gives us a net income for the month of that amount. On the balance sheet, once again, we go back to the ledger. If we would look at the cash, if we look at accounts receivable, inventory, remember we look at ending balances. Let's look at inventory just as an example. We go back to inventory in our ledger and we find the ending balance is $17,700. That's what we show. Always show the ending balance, and that's what's on the balance sheet. Supplies is there. The computers, once again, in the asset section, we still show the initial purchase of the computers of $7,500, and then we'll subtract the contra account, and we'll show that on the balance sheet. That $62.50 in parentheses indicates a negative number. We look at, liabilities, and again from the ledger, we plug in accounts payable, loans payable, and these 3 the 3 payroll liabilities that we have, and we add up liabilities of $49,470. Now to find at this point, and this is the new part that I want to emphasize to you, right now to find the owner's equity, if you look down here, there's a note. Find this amount by using the accounting equation. Total assets, this number, minus total liabilities, this number, will give you the owner's equity. And that's important at this point. I'll explain why in a moment. But you subtract the total liabilities from the total assets. That's the accounting equation, giving you owner's equity. Then if you add these 2 numbers, liabilities, owner's equity, you'll come up with a balancing number for our balance sheet. Now I mentioned this because everything else on these 2 statements should be correct, except if you look at owner's equity, this balance is $62,125. It's not what we just figured on our balance sheet. And that's the glitch that we have to account for, and that's what we'll be doing in topic number 9. So review this if you need to, and answer some questions back on your course page.